Now, this necklace might look like gold, but it could be worth almost nothing as an investment. For over 5,000 years, gold has survived wars, inflation, collapsed empires, and failed currencies. Yet, today, most people buying gold have no idea what type of gold they are wearing, how much gold is actually inside of it, whether it is an asset or just expensive decoration. In this video, I'll break down what real gold actually is, the difference between gold jewelry, gold bars, and gold coins, and how smart investors combine all three for resilience. Let's start with the basic. What is gold? And why do humans obsess over it? Gold is inert, meaning that rarely interacts with anything else. Gold is rare, it's durable, divisible, and does not corrode. That's why it doesn't rust, it doesn't decay, and it does not disappear over time. In The Richest Man in Babylon, gold is described as money that labors faithfully for the wise owner. Empires rise and fall, gold remains. Morgan Housel echoes this idea in the book Same as Ever. Human behavior does not change. Fear, greed, and uncertainty, these always return centuries after centuries. And gold still thrives in those moments. But here is the mistake most people make. They assume anything shiny is equal to investment grade gold. That's not true. So, briefly, I'm going to distinguish between gold-plated, gold-filled, and solid gold. Gold-plated, it simply means a very tiny layer of gold plated over cheap metal, often less than 1% gold. Gold-plated jewelries, they wear off over time and have almost zero resale value or melt value. So, gold-plated jewelries are simply fashion, not investment grade ownership. Number 2, gold-filled. This usually means a thicker gold layer bonded to base metals, usually 5 to 10% gold by weight. Better durability, still not investment grade. And number 3, solid gold. This is the real deal. Here, gold is mixed with alloys throughout, and it holds long-term value, can be melted, resold, or inherited. If you are thinking wealth, solid gold is the starting point. Now, let's talk carats. I'm going to explain gold carats to you from 9 carats up to 24 carats of gold. 9 carats simply means 37.5% gold, and then it includes other alloys like copper and silver. 9 carats is strong and has the lowest gold content once we come to solid gold jewelry. 9 carats is good for wearability, but poor for investment. 14 carats. This one is 58.5% gold and a good balance for durability and value. However, it's still heavily alloyed, okay? It still has about 41.5% of silver and copper. Next one is 18 carats gold. This one has 75% gold, a rich color, and popular for fine jewelry. With 18 carats, this is where wealth preservation starts to show up. 22 carats. This is 91.6% gold, and it's usually common in Asian markets, Middle Eastern markets, and African markets. This one is heavier, softer, and closer to pure gold. And it is often used intentionally as portable wealth. Now, finally, 24 carats gold. This is 99.9% gold. It is too soft for daily wear. scratches easily, and deforms over time. So some people still wear it as jewelry, whereas others can buy it but keep it more as an heirloom. Gold is not brittle like glass, but it is actually soft. In order to make wearable jewelry, it has to be hardened with alloys, which brings us to investing. Here, I'm going to be talking about gold jewelry versus gold coin versus gold bars. Gold jewelry's pros, advantages. It is wearable, cultural and emotional value across generations, and it is portable wealth. Cons or disadvantages. 1. It has a high markup, which comes from design, labor, craftsmanship, branding, and it is not priced at spot gold value. In other words, it is not really tracking the spot value of gold, and it has a lower resale efficiency. In investing terms, jewelry is gold plus lifestyle costs. It is not pure investment grade. Please take note of this. Gold coins. Gold coins are usually 24 carats gold, which is 99.9%. Usually minted by the government. In the UK, you can get this from the Royal Mint. It is easy to recognize and resell, and it has a lower premium or markup compared to jewelry. Examples of gold coins, we have Britannia and American Eagle. Coins balance liquidity, which is they are easy to resell, and purity, 24 carats. Number 3, gold bars. Gold bars are also 24 carats, which is 99.9% gold, and this is pure. Lowest premium per gram. Best for pure exposure, but it requires secure storage. Gold bars are not emotions like jewelry and sometimes coin. Gold bars are pure maths. No emotions, pure maths and investments. Why is gold jewelry marked up, and why does that matter? When you buy jewelry, you pay for craftsmanship, branding, retail margins, marketing, taxes. So when gold price rises, bars track the spot price of gold closely. Coins track fairly well, but jewelry lags behind significantly because of the markups due to taxes, branding, craftsmanship, retail margins or profits, marketing, etc. So gold bars will track the spot price of gold tightly, gold coins follow behind, and jewelry lags behind. However, gold jewelry is still good as it plays a crucial role in diversifying your gold collection, and I'm going to explain this later on. So, how do you buy gold jewelry smartly and investment aware? If you want jewelry that preserves wealth, number 1, you can buy solid gold only, which is 9 carats, 14 carats, 18 carats, 24 carats, 22 carats of gold jewelry. Number 2, look for hallmarks and stamps. Ask for the certification of the jewelry. Buy close to the melt value, close to the spot price of gold as much as you can. This might mean going to the goldsmith to buy. Avoid heavy branding, okay? If you are buying them for investment purposes, just go for gold. It doesn't matter if it's branded or anything. Gold is gold. Like I said, as much as you can, buy close to source, goldsmiths, and buy on discounts. When you see those golds on discounts in different retails, you buy from them, not necessarily based on emotions. This is how gold has quietly transferred wealth across generations. Gold as heirlooms and intergenerational wealth, or what we call generational wealth. So gold is used across cultures for weddings, births, inheritance. Gold isn't just decoration, it's memory stored as money. In the book, The Richest Man in Babylon, wealth is meant to protect the family long after the earner is gone. And gold jewelry does that in a way that ETFs, which are exchange traded funds, cannot do it. Gold jewelries can protect the family or the generation even long after the earner or the person who bought them has gone. And this protects that family in the way buying shares or gold ETFs cannot protect that family. We are coming to the end and we are going to be seeing how we can mix gold assets for resilience. Smart investors don't choose one form of gold. No, they combine gold bars for purity and price tracking. 2, gold coins for liquidity. 3, gold jewelry, cultural, emotional, portable wealth, and transgenerational wealth. And gold exchange traded funds, gold ETFs, for their convenience and liquidity. So, just like diversification across assets, you can diversify within gold itself. This aligns with ideas from the books The Psychology of Money, Same as Ever, and The Intelligent Investor. Gold is not necessarily about returns. It's first about survival, stability, and risk preservation. Final thoughts. What does gold really represent? Gold doesn't make you rich quickly. It makes sure you are not wiped out completely or slowly. It is insurance against inflation, currency debasement, human panic. And as history shows, gold always waits patiently. If this video helped you to see gold differently, like, subscribe, share it with someone buying jewelry without understanding it. Drop a comment to add more to this video, your thoughts, insights, feedback, and much more. And as always, stay curious, stay patient, and keep compounding wisdom. See you in my next video. Bye.